Hi, Jonathan York, Bay Financial Partners, looking at the investment markets. A really pretty tumultuous last few days for global equity markets. Really sort of started off obviously with the coronavirus, but then sort of hard on the heels of that was Russia playing hardball with OPEC in terms of production cuts for oil. Now that saw crude prices fall by nearly 30% and really sent, say, global equity markets into a bit of a tailspin. US markets saw the circuit breakers implemented for the first time for a long time, with the S&P falling more than 7 points about 3 minutes after the opening. I suppose really what was quite interesting though after that, really the market sort of hovered between sort of 7 and 8% down. Certainly on the Dow, that meant the biggest points drop, over a 2,000 point drop on the day. All sectors were impacted, but really obviously the major impacts were obviously sort of tourism, airlines, and obviously the oil companies. Financial and banks fared pretty horrendously as well. Obviously, with the emergency cut from the Fed, taking interest rates down. There's now sort of priced in really by sort of June of this year that the Fed funds rate will be down to around sort of 0.5%, if not zero. So what it all looks like is that potentially certainly central banks now are heading back to sort of zero interest rate policy and potentially in the next round of a quantitative easing. But really monetary policy is not going to be the sort of sole cure for this. Really needs some fiscal help from the governments. There was a little bit of talk yesterday from President Trump about a potential payroll tax cut. Yet to see the details on that, but certainly the market got a little bit of a boost from that. Really what is needed is that, some pretty major sort of fiscal help out there, infrastructure spending, maybe a little bit of tax relief, and, really just trying to help the central banks as well, because certainly monetary policy isn't going to cut it this time. Now all that comes on the back of some pretty strong data out of the US, but obviously that was sort of backward looking, rearward looking if you like, on the employment data. That was much stronger than anticipated. Coming in at 273,000 versus about a consensus of 175. But obviously what will be interesting is the next sort of couple of months reading, because certainly, potentially there is some layoffs, and it's if crude stays down at these sort of low prices as well, potentially there's going to be some pretty major layoffs in the shale industry in the US. Now, certainly with the Russian sort of failed to come to sort of an agreement on the production cuts, it looks like they are targeting the US as sort of shale industry and really trying to cut that production back by maybe as much as sort of 2 to 3 million barrels a day. But really what we do have in the oil market is really a sort of supply crisis, also a demand crisis as well, because, certainly you've got oversupply, but also as well, obviously, with the coronavirus and sort of countries, some going into complete shutdown like Italy, but also, restrictions on travel, etc. There is less demand for oil. So you've got falling demand, and you've also got oversupply as well, which is really sort of a perfect storm for lower prices for oil. US election is still in full swing, and really the Democratic nomination is now down to sort of pretty much a two-horse race, with certainly Joe Biden having the momentum after Super Tuesday. Some pretty important primaries this week, and it's just going to be interesting to see how he comes out, obviously, against Bernie Sanders. Quite interesting on the coronavirus. We've seen President Xi visit the Hubei province, which is where the disease supposedly originated from. That's the first time he's made a visit there, and maybe it's a pretty clear indication that certainly cases out there are starting to wane, but also as well the sort of areas getting back to sort of a more normal sort of stance. So certainly the pretty draconian measures imposed by China in terms of sort of shutdown of around 47 million people seems to be working in regard that the number of cases in China is certainly falling. But clearly now it is a global issue, and obviously Italy is the latest sort of hotspot, and the Italian Prime Minister has now put a countrywide ban on travel, really put the country into lockdown. What has really surprised many people, though, has just really been the speed of this sort of fall correction, bear market, call it what you want at present, it's still yet to be defined. But clearly the market is down 20% from its highs, which was really late sort of February. But obviously those falls have come in the space of nearly a week. Now, certainly with the falling oil price, obviously that's pretty good news for the consumer at the gas station, because certainly gas and petrol is quite a bit cheaper. It's just going to be interesting to see if that is now sort of spent into the general economy. Because certainly what was quite interesting, and with the big fall on Monday in the US equity market, Walmart was actually up just over 2%. And that was on the back of cheaper gas prices, which should translate into more spending. Now here in New Zealand, obviously not immune from the coronavirus, currently around sort of 5 cases. But quite interesting, the first case of the infected person now looks like they have recovered sufficiently enough to be released from hospital. Now clearly it's going to have an impact on the New Zealand economy. Certainly logging, dairy, tourism are all going to have some pretty major impacts on the New Zealand economy. And that, coupled with the drought as well in the North Island, really could be a little bit of a sort of a double whammy for the New Zealand economy. And it's going to be interesting to see how it sort of plays through. Certainly there's quite a bit of increased pressure on the government to sort of do a little bit more. And one of the major sort of talking points is the increase in the minimum wage coming through in April. A lot of talk that should be now postponed because it's just going to put too much pressure on small businesses. Certainly it seems pretty much a foregone conclusion now the Reserve Bank will cut rates later this month, more than likely by 0.5 point. That'll take the OCR down to 0.5. Now, obviously, if that is the case, that puts further pressure on investors out there who are looking for income. Certainly, if you're relying on your sort of term deposits, because they are more than likely going to fall as well. And so that just puts more pressure out there as investors search for yield. So if you are interested in discussing what options are available out there, call us on 0800 867 323 or go to the website www.bayfinancialpartners.co.nz for lots of interesting articles, and we look forward to speaking to you soon. Also as well, obviously with this equity volatility, quite a bit of talk about KiwiSaver. The thing to remember about KiwiSaver, it is a long-term investment. You are investing for your retirement. So although it's not great, the current volatility in share market falls, the bigger picture, it doesn't really matter too much, because what you're doing, you still got to contribute, you're still getting the same shares, you're just getting more of them at a cheaper price. And it was really important to to keep your discipline out there. If you're still you're sort of mid 30s, it's going to be 30 odd years before you can access those funds. As with all long-term investing, it is time in the market that really counts. Makes a huge difference.